While most traders were chasing calls on Micron, we just closed out of a credit spread, quietly making us 25% overnight. I'm going to walk you through how we identified the trade on the chart, how we structured the trade, and how we manage it from start to finish with our members. Let's start out here. This is an hourly chart of Micron. This is what we use to find what we call our weekly gems trades. These are trades that typically have a 1 to 4 day holding time. We take these trades with credit spreads. They're fully risk-defined trades, oftentimes tying up right around $200 of capital per spread. Great way to stay engaged in the market, turn over your capital on a frequent basis, and best of all, you don't need the big account to take these trades. If I take a look at this chart, Micron has been one of the strongest names on the board. It has been absolutely phenomenal. And when I identified this as a candidate with our members yesterday, I had some pushback from people saying, why are we going to fight the trend that's in place? The key with this hourly chart, we have to be open to trades in both directions. Long term, I don't care if the market moves up or down. It does not matter to me. With these weekly gems trades, I'm just looking for a short-term trade. I'm looking for opportunities both on the upside and the downside. I'm looking for those liquid products, the names that stay active on a regular basis. And we all know that the tech stocks are doing that right now. And if we take a look at Micron, if we go back to the chart, and let's go ahead and take a look at our yellow dot that set up for us yesterday. That yellow dot came at 411.79. That's what we classify our standard weekly gems trade, right? You can see price started to break below our channels, right? We had our pulse indicator below zero. What that's representing is energy starting to be released on the downside. Oftentimes when you see a bearish setup on what has been a strong product, oftentimes you can get intimidated by that, saying, well, do you expect the top is in? Do you expect the market to crash? Not at all. I am just simply looking for a very short-term trade over the next few days. Look to get in and out very, very quickly. Try to book a profit from that energy being released on the downside. Doesn't mean we have to get ultra aggressive. If I were to come in and buy a long put, I would only have one way of making money. It's going to tie up more capital, and a long put needs the stock to move to the downside. If it does, you're going to be rewarded for it. But what happens if the stock just chops? What if we start to settle into a sideways range? Or what if it continues to move to the upside? You're in trouble, right? That's why we decided to go with the call credit spread. And what we did specifically, we sold the 435, 437.5 call spread. We collected $84 per spread. It tied up $166 of our capital per spread. It's a fully risk-defined trade. If we are dead wrong, the most I can lose is $166, right? And all this means, it doesn't have to be overly complicated, doesn't have to be advanced. All I'm doing is selling the 435 call and I'm buying the 437.5 call at the same time. All I need there is for the stock to stay below 435. Up, down, or sideways didn't matter to me as long as the stock stayed below 435. I was okay. I also had the benefit of time decay helping me, and I made money from volatility decreasing. Any combination of those five was going to work for me. Now we can clearly see what happened on Micron. The stock is down over $50 today. Did I need a $50 move to the downside? I didn't. It's great that it happened immediately because overnight we are able to book the profit on the trade. First thing this morning, we held overnight. First thing this morning, we closed out of the position and booked 50% of the max profit. It gave me a 25% return on my capital overnight from a fully risk-defined trade. Now, I'm giving you the numbers here based on one spread. You can take this trade with 10, 20, 30 spreads. Doesn't matter. The trade remains the same. You're simply just adjusting position size based on how much capital you're working with, right? You take this trade with 10 spreads. Now you're talking about just over $1,600 of capital required. And now you're talking about a $420 profit overnight. Great way to see a nice return on your capital with a fully risk-defined trade. Now, if we go over to the brokerage page here, you'll see the spread is trading at 7 cents. Had we held, we could have made more money, right? However, with tech, we have seen a lot of the dips bought up. Right? We've seen the dips bought up now for months. What I didn't want to have happen is hold into this afternoon, or even into tomorrow for that matter, and try to book the bigger profit. Because what happens if the dips bought up, I end up giving back all that profit and then some. These weekly gems trades, we're typically looking for between 3 and 10 days left to expiration. We're either going with that current week's expiration cycle, or I'm going out an additional week. In this case, we went out 10 days. That close to expiration, the time decay is very active. Those options are also very sensitive to anything the stock price does. With these trades, I'm looking to get in and out as quickly as possible. That's why we booked the profit this morning. You can see here it's bouncing all over the place. But what we have to ask ourselves is, is it worth continuing to hold when at this point the spread's now trading for 20 cents? I only have 20 cents of additional profit potential. To book that 20 cents, I have to hold all the way up to the end of next week. I don't want to do that. I'd rather take my 25% return on my capital, free up the capital, and redeploy that in something fresh and new here over the next couple of days. This is how we like to trade options each and every week. Not holding positions for weeks or months at a time. I'm looking to be very, very active. I'm looking for defined risk trades. I want to know what my max risk is right up front, especially in today's environment that is so sensitive. We're seeing volatility wake up. These are the types of trades that allow us to see the consistent gains over time. Now, if you would like more information on how we're trading options at NetPicks, if you'd like more information on how we utilize the credit spreads, click on the link here in the description of the video. We will get you a free report giving you more details on how we utilize this strategy. So any questions, feel free to post a comment on the video. Like and subscribe to the channel. That would be great. It would really help us out. And if you do have any topics that you would like us to cover in future videos, feel free to let us know and we'll get that content to you. All right, I'm going to wrap this video up here. Enjoy the rest of your day, guys, and we'll talk to you over the next few days with our next video.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.